When it comes to investing, obviously you need to plan out everything, from the stocks you pick to the strategies that you use in order to effectively grow your money. You can't just blindly invest and hope that luck is going to be on your side, because unfortunately, it's not like the lottery. How you plan things out affects the outcome of your investments, even more so when it comes to deciding your time horizon. But what is a time horizon and how can it influence your success rate in the stock market? How do you effectively set a time horizon anyway? We'll find out in today's video. Hey, welcome to Stock Market Mate. Today we'll talk about how to invest based on your time horizon. Before we get into it, subscribe to the channel and hit the notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. According to a Forbes article on why time horizons are important, we need something to base our decision on as investors, a sort of compass to see where we're headed in order to successfully beat the market and make the most out of our money, such as personal goal or standard. With these goals, we create what is called a time horizon in order to achieve our desired results and also avoid risks in the long run. A time horizon is simply a specific timeline suitable for your investment goals. Your time horizon includes how long you're going to hold your assets before selling, as well as the timeline you need to rely on in order to figure out how you're going to achieve your investment or financial goals throughout the years. Additionally, you'll also be able to navigate yourself through risks and drawbacks easier as you have a clear vision in your mind of what your focus should be. With that in mind, let's dive more into the reasons why having a time horizon is important in investing. The importance of a time horizon. Minimizing risks. We talked about having a time horizon in mind can greatly lessen the risks. That's because knowing your focus helps you be aware of what's necessary to your goals and what isn't. Having a concrete idea of what your focus is gives you better solutions to potential problems. There is no formula for success other than understanding and mitigating risks before taking them on. Having an understanding of your time frame and your investment objectives can greatly reduce the risk that noise can present to you. Higher success rate. The key here is to match the time horizon of your goals with that of your strategy. This is the basis of maximizing your chances. Because you already have a clear focus in mind of what you want to achieve, you'll find it easier to know the time frame you need as well as a strategy to coordinate to achieve said goals. One thing to always keep in mind is that an increasingly short time horizon, especially one that falls below 10 years, when performance begins to become unpredictable, makes goals more vulnerable. In that case, you should consider realigning your time frame through strategies with a reasonably predictable period of time. Investing long-term. Long-term are more predictable than short-term. The reason for this is averaging. For example, long-term investors can look at return goals with a reasonable expectation that they will be met. When shorter time horizons, however, noise can dominate. Therefore, it is important to take extra caution as you near retirement. All in all, your time horizon plays an important role in determining how much and how often you need to save or invest to reach your goals. Additionally, stocks, bonds, and cash are three different asset categories you can incorporate in your plan. Investing in a combination of these assets can be beneficial, and a financial advisor can help you determine the best allocation to meet your objectives. How to evaluate time horizons for specific goals. You can achieve your financial goals and maximize your returns along the way by understanding your time horizon. Depending on the specific goal, the time horizon could fall into one of three categories. Short term, less than 3 years. Mid-term, 3 to 10 years. Long term, more than 10 years. To give you more perspective on this, think of a 27-year-old man who wants to buy a house by the time he reaches 29. Using this example, we can see that he has a 2-year time horizon, which is considered a short-term goal. Let's say he also wants to pay all of his debts by the time he reaches 39. In this case, it could take 10 years to accomplish, so this is a mid-term goal. Lastly, let's say he also wants to retire comfortably at the end of his career, perhaps at the age of 70. This then is a long-term goal which has a time horizon of decades. Throughout his lifetime, however, it is possible for his priorities to change. Upon reaching age 50, he may wish to retire early, at 60. It would be wise to update his strategy to take into account a shorter time horizon. Now that you have a clear understanding of the time horizons necessary according to your goals, let's take a look at different forms of risks according to your investments and how we can use your time horizon to mitigate them. Understanding investment horizon and risk. Investment strategies should take into account the inherent risks associated with each type of investment. A market downturn can cause businesses to fail, borrowers to default, and even sound investments to be vulnerable. This time, let's take a look at some of the forms of risk as well as how they can affect each type of investment. Market risk, also known as volatility risk. Market risk refers to the possibility of an investment value to be negatively impacted by crashes and most especially global events. Since markets trend upward in the long run, this makes market risk a huge concern for those with short-term and mid-term investment horizons. Default risk. This is the possibility that a borrower might not be able to repay debts. Default risk usually applies to bond issuers, however, it could also be referred to other securities that are based on debts. In order to reduce your exposure to this risk, investing in bonds with high credit ratings is a good start. Business risk. Business risk refers to the possibility that a company might go bankrupt and fail, which will cause stocks values as well as bond values to plummet. Although no company is immune to such risk, one thing you can do is avoid risky companies altogether by carefully analyzing them and evaluating their business plans. Additionally, you can also reduce your exposure to one type of business by making sure your portfolio is diversified. Interest rate risk. This is the possibility of an unexpected increase in interest rates which could consume most of your investment gains. This is typically a huge concern for fixed income securities such as bonds. Moreover, you can reduce this risk by holding bonds of different durations as well as making sure to invest in interest rate derivatives. Inflationary risk. Inflationary risk refers to the possible risk that real investment value might plummet due to unforeseeable increases in consumer prices. In particular, bonds are susceptible to such inflation as coupon rates are fixed, and so an unexpected spike could corrode expected investment gains. Although you can mitigate such inflationary risk through Treasury inflation-protected securities, or better known as TIPS. TIPS usually provide protection against inflation. It's important for every investor to carefully evaluate their investment goals as well as their necessary timeline before they can decide where to place their money. Although your savings accounts and CDs can be a good place to put your money, not to mention that they're very convenient, it's highly possible that they will lose their value due to inflation and in turn might not be such a good idea after all. On the other hand, aggressive investments will be expected to generate high returns in the long run, though they will still be vulnerable to short-term fluctuations in the market. It's ultimately up to investors to make the decision of how to best balance risk and rewards. Moreover, investing based on your time horizon all comes down to careful planning. It's important for investors to think about their personal goals. Once that's set in your mind, your investment choice will be based on how much time you have until your goal must be met. As the funding date approaches, assets are adjusted to investments that are more conservative in order to decrease the chance of risk of losses that's market-related that hinders your investment strategy. Well, that's about it for today. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!